startups, its formation and terminologies. What next?
Now, once the startup is formed, what next?
We start business, start making profits and earn income.
Where there is income, arises income tax.
What are all the challenges that are faced by startups?
So, to know about all these, we have the next three paper presenters all geared up to impart us with this knowledge.
So Bhavna, what are all the aspects that we are going to cover in this technical session?
We are going to be covering Section 56, Rule 11 UA, Section 50 CA, Section 54 GB, Section 80 IAC, and ESOP taxation for startups.
That sounds very interesting, right? So all of you settle down, seatbelts on, and get ready for this interesting session. In order to take you all through this interesting session, we have a renowned personality with us today, CA Ajay Rotti.
I request Surabhi to kindly escort CA Ajay Rotti sir on stage.
A big round of applause for CA Ajay Rotti sir.
I request our paper presenters to kindly come on the dais.
Anis, Krupa and Shaktivel are here to take over the session today.
So before we hand over the session to the session chairman, we take immense pleasure to get to know him better. So here is a video where you can get to know him better.
Founding partner Dhruva Advisors and is based out of Bengaluru. Dhruva Advisors is a boutique advisors firm offering a wide range of services in the tax and regulatory space to clients in India and around the world. Prior to co-founding Dhruva Advisors, Ajay was a partner international taxation at KPMG. Ajay has 20 years experience in the tax and regulatory arena. He also has considerable experience in corporate tax, transfer pricing and international tax areas. He has advised a large number of multinational and large Indian companies on a range of direct tax and regulatory issues. He has expertise in the information technology and real estate sector. Also has represented various multinational and Indian companies before the regulatory authorities and tax tribunal on corporate tax and transfer pricing assessments. Ajay is a fellow member of the Institute of Chartered Accountants of India and holds an advanced diploma in management accounting from the Chartered Institute of Management Accountants, United Kingdom. He's a gold medalist in BCom and was a Bangalore University topper in cost accountancy. He's a member of the Executive Committee of the International Fiscal Association, Bangalore Subchapter, a member of the Direct Tax Committee of FICCI. Ajay is also a member of the International Taxation Committee of the Institute of Chartered Accountants of India, a board member of the WTS Global, a network of tax advisory firms in 100+ countries. Ajay is a regular speaker at conferences and seminars and has also authored several articles in leading business newspapers and tax magazines. Ladies and gentlemen, Mr. Ajay Rotti, founding partner, Dhruva Advisors.
Now I request CA Ajay Rotti sir to set the context for our student speakers to take over.
Good afternoon. I think before I get into the challenges for startups, I think the bigger challenge is for me to deliver this and handle this session after lunch, because tax generally would put people to sleep even otherwise. And I did have lunch, and lunch was very good. So that's a bigger challenge, and then we'll move on to the other income tax challenges. What I thought I'll do over the next, say 10 minutes or so, before your friends come on to make details presentation, is to just set a context as to where the tax landscape is today and how it is changing. At the cost of sounding old, I was sitting in one of these conferences 20 years back, and what tax was then to what tax is today is very, very different. And you would have seen a lot of news article, things in social media, press, TV, etc. on tax for reasons which ought not to be. What was the reason for tax to be coming in and having such an important role in election of the recent Prime Minister of UK, and what tax positions his wife took in the return of income, etc. But unfortunately, that's where tax is. So what really is changing? Apart from the rules, the sections that are coming in, the complications and the complexities that are coming in the technical aspects, what is also changing is how people are viewing taxes. What happened a few years back is the Starbucks case, and I'm just taking it for the purpose of driving home a point, nothing to do with Starbucks or nothing to do with any other company, including Google here, which you see on the slide. Starbucks arranged its affair sticking to the transfer pricing regulations. Very simply put, what they did was, when they set up their UK operations, the UK Starbucks entity used to make a cappuccino, and the know-how for that used to come from another Starbucks entity. They had a loan from another Starbucks entity, all intercompany, and they used to make those interest payments, they used to pay royalty for those, they used to buy coffee beans from another entity which used to source globally and supply it to UK. So Starbucks UK used to always have a loss, and this was well within the tax regulations, well within what transfer pricing regulations laid out, to say that you carry out transactions at an arm's length price. But Starbucks UK used to have a loss, and what really triggered the outcry and public outcry and drew all the attention was the Starbucks chairman in the letter to the shareholders wrote that our UK operations are profitable and we would want to invest more and open more stores in UK. So people in UK said, if Starbucks is not paying taxes to HMRC and they're having losses here in the standalone entity, why is the chairman telling that the UK operations are profitable and they would want to expand more? And that's where, these kind of things had never happened in the past, where people on the street started protesting. And in UK, as you can see in some of these pictures here, people stopped going to Starbucks. Starbucks saw a decline in their business. So eventually Starbucks ended up paying a $10 million tax, £10 million tax voluntarily, and then thereafter settled this issue. Something similar with Google, we are reading something similar about Amazon. It's not about these companies, it's really how tax is being viewed today. Because no longer is the old view of us arranging affairs in a particular manner leading to a low tax or a no tax being accepted, because the concept of morality is being brought into tax, and I'll come to that in a minute as to whether morality needs to come in or not. So what has also happened consequent to that is the regulators have got into action. Most of you would have read this, most of you are aware, the OECD, BEPS, whole project, the action plans that they have put out is all to avoid multinationals from saving taxes, avoiding taxes, and arranging their affairs in such a way that the taxes in certain jurisdictions are different than what it should be. So we are today dealing with a situation where companies are looking at their tax positions. There is a greater scrutiny, not just by the tax regulators, but by the civil society, by the general public, by it's getting drawn into, like I said, into politics and everything. Plus, the regulators are connected, they are coordinated. This is changing the entire way we look at tax. And this is important for you to understand, to bear in mind, whenever you're looking at any tax issue, whenever you're looking at anything to do with taxation today, whether you are practicing by yourself, whether you'll set up a practice and advise your clients, or whether you are in the industry heading taxes for a particular company, you need to be aware today that the concept of morality is coming to tax. There is this whole discussion about moral rate of tax. Earlier, there used to be a headline rate, which is the 30% tax that we all know. Then there is an effective tax rate, which is nothing but what you would pay. Today, there's a moral rate of tax, and discussions have started around that, which is to say, should somebody be paying their fair share of tax? What is fair share? It's either in the law or it's not. But we are today at that situation where there are morals being built into your tax positions. Therefore, can you afford to push the envelope? Can you afford to take very aggressive interpretation like you used to take earlier is a question that's open. Then there is more transparency today. There is a, if you look at only locally, CBDT and CBIC have an exchange of information. Today, there's always a comparison between what you do in your GST and income tax, and you need to explain those. So there's a lot more transparency that is coming in, a lot more coordination between the regulators that is there. Like I said, there's an active civil society that's come in and interesting, and I would really suggest each of you to look up this, to look for a fair tax mark. This is in the UK. Like you have the ISI mark and other marks, there is an organization which is giving a mark which is called the fair tax mark, which is to say once that mark is given, then that group is actually adhering to the tax regulations and not avoiding taxes. And there are set of people who, like you today, buy only organic food. There are people who want to go only deal with companies which have the fair tax mark. So that's where we are moving to. And then tax is now a lot more than it used to be even 8-10 years back, more in the boardroom, more in politics. What this is leading to is tax is now having an impact on your brand. The companies are known for what the positions they take on tax. No company today wants to have a large tax litigation, wants to be seen as a company which is dodging taxes. So you need to remember this. This is an extremely important aspect because most of your approach to taxation now will be driven by this. We can't be any more seen as chartered accountants, being seen as the people who are there to reduce the tax liability of companies and reduce the tax liability of the clients. That is a fundamental shift in the last 20 years that I have seen. When I was doing my articleship and thereafter qualified immediately, one of the things that was expected is you go to a chartered accountant, he'll reduce your taxes. And we've moved far away from that. I think all of us today need to know that our responsibility is far greater. We need to be telling our clients to be working within the borders of law, not stretching it too much, to be paying what is actually due. And we have a responsibility today to be helping them protect their brand, because a tax litigation, an aggressive tax position actually goes and impacts the brand of companies. This, I thought, was an important context that has to be set when you are looking at all the challenges, because what we are going to now discuss is what is it that as startups today in India, the challenges that exist from a taxation perspective. What, like I said, your friends will discuss and present detailed presentations on 3 aspects. One relating to angel taxation, the other is ESOP taxation, and thirdly, what incentives are available to startups in India today. These will be detailed technical discussions, and please soak them in. Any questions, if you have time, we can take that later. Thereafter, I would want to spend about 15-20 minutes just giving you a flavor of what else is there other than these 3 things. There's a lot of efforts that has gone into these 3 presentations. So please request you to pay attention and concentrate on what's going to be discussed now. There's 15 minutes each for these 3 presentations. And I'll just call on the first speaker. Anis? Anis will talk to us about the incentives that are available to startups.
So much, sir, for setting up the right context and taking us through the topics. The rules for the session is as follows. For every 12 minutes, there will be a placard displayed to the speaker right in the center of the audience. Also, there will be a placard displayed at the 14th minute, and adhering to the 15th minute is appreciated, and that is expected.
Now, moving on to our first speaker, who is here to talk about Section 54 GB and Section 80 IAC. An avid and enthusiast public speaker with love for speaking and writing. A winner at ICI's National Level Elocution Contest 2019. Anis Sayani, a person who hails from Goa and a CA final student. Please give it up for Anis Sayani.
So before the timer runs, a small disclaimer that the main portal of information shall be me, and the PPT is only meant to supplement the information. So, India is an aspiring nation, a growing nation, where the aim of us, the 130 crore Indians, is not just to alleviate poverty or do away with it, but also to fulfill our aspirations, to start up. This is precisely what brings us to this pathway of entrepreneurship in our country. Now, the Prime Minister of this country has rightly said that several big companies and corporations of today were the startups of yesterday, which is precisely what we are here to discuss today. I'm here today from a state where you just might end up this month end, Goa. My name is Anis Sayani. I'm pursuing my CA final, and I'm here to present my views on two very essential enablers, or I would say catalysts, which are available to startups in this country and which are contained in our very own Income Tax Act 1961. The first of these is Section 80 IAC, which is nothing but a tax holiday which is given to these startups in their initial years, up to 10 initial assessment years from incorporation. The second aspect which I'll deal with is basically how do you bring funding to these startups? How do you incentivize general public like you and me to invest our money into these startups, which is exemption given to individuals and HUF through Section 54GB. Without much ado, let me begin with the first part of my presentation, which is Section 80 IAC. Even during the economic downfalls, stagnations in this country, it has always been the startups who have appeared to be this ray of hope, the employment generators, the foreign investment attractors. Therefore, the government has been striving to give them this small tax holiday as an incentive available to them. What is it? It is simply 100% deduction of their income from business or profession for 3 consecutive assessment years. Mind you, 3 consecutive assessment years out of any of the first 10 initial assessment years. If this seems fine to you, I don't know if it seems fine actually, because there's this question that it is available to whom exactly. It is available to eligible startups who are engaged in an eligible business. An eligible startup in an eligible business. 2 terms which we shall discuss at length, but before that, let me introduce you a character of my story which is purely fictional, and any resemblance to any animal, human, living, dead is purely coincidental. The first character of my story is Ratan Limited, a startup which is purely innovative with huge employment generating potential, promoted by me. Would Ratan Limited qualify to be this eligible business engaged in an eligible startup in an eligible business? So to take you back a little bit, this definition of eligible business which we see on the screen is post-amendment. There used to be a definition which necessarily required these startups to invent products, to have new products, to mandatorily make use of technology, which was extremely stringent. As a result of this, a meager 78 to 80 startups were eligible under 80 IAC out of 1700 applications up to the 21st meeting of this interministerial board. So this is how the definition stands today, and fortunately we at Ratan Limited have qualified these conditions. But are we an eligible startup too? So mind you friends, if you wish to incorporate your own Ratan Limited, your own startup, set your date to 1st of April 2023 as the last day to incorporate it. Let's say we've met it. Ensure that your turnover in any of the assessment years where you're claiming this tax holiday does not exceed 100 crore. Let's say we meet this as well. And the third condition is the certificate which I just told you about of carrying on the eligible business. Let's say we at Ratan have met all of these conditions. Does it seem fine to everyone? Because I have one doubt again over here as a challenge. Let's say my company, our company rather, Ratan Limited, incorporated in previous year 22-23, started claiming this tax holiday of 3 consecutive assessment years from 23-24, went on in 24-25, but in 25-26 the turnover exceeds 100 crores. Does it mean that I need to reverse the entire deduction which I've claimed in the previous assessment years? Or do I only need to reverse? Or am I only ineligible to claim the deduction for that particular year? This, in my opinion, is something which needs more deliberation and emerges as an issue, in my opinion, which is the sole purpose of this technical session. Now, beyond this point, your startup, let's say, is not your original idea. Then you cannot claim the benefit under this section. Because for you to claim the benefit for your own Ratan Limited, you cannot form it by splitting up, by reconstruction, nor can you purchase assets which were previously used by any other business. Of course, a rationalization of 20% is permitted. Now let's leave Ratan Limited aside for a little while, and let me bring in another character in my story. His name is Anmol. Somebody who has just sold his house property, has some long-term capital gain, and doesn't know what to do with it. Up to the year 2012, he could have probably, gained his exemption via Section 54. But in 2012, things began to change. How exactly? There was this national manufacturing scheme by the government of the country to promote the micro, small, medium enterprises to enter manufacturing. And it benefited individuals who were willing to invest their hard-earned money into these MSMEs. But in 2016 came the Startup India initiative, after which this section has continued benefiting the startups, continued benefiting those individuals and HUFs who are willing to invest their monies into these startups. Now, if we want Anmol to invest his money into our startup Ratan Limited, 54 GB has given us 3 conditions to be fulfilled. Let's look at them one at a time. Condition number 1, there has to be a transfer of a long-term capital asset which must be a residential property. Seems fine up till now, until you read the brackets which say it can be either a plot of land or the residential house which it says. My doubt over here is with this plot of land. So let's say if there is a plot of land with residential properties and commercial properties adjacent to it, it could again be a challenge or an issue as to whether this plot would actually qualify to be a residential property, because it is a precondition for the individual to claim, for Anmol to claim the exemption under this particular section. Condition number 2 prescribed in 54 GB subsection 1. Once there has been this sale of residential property by Anmol, he gets his money, he gets the net consideration. Now mind you, the net consideration which he gets from selling this particular property of his, he has to invest this into subscription of equity shares of an eligible company. The most important highlighting term here is this eligible company, which needs to be understood at length. But before that, do remember that he needs to invest his net consideration and not the long-term capital gain amount. Do remember he has to subscribe to only the equity shares, and do remember he has to actually subscribe to it. Whether it's allotment or not, we shall look into that issue as well. So, talking about this eligible company, it has again 4 conditions to be fulfilled. First, with regards to incorporation. Let me continue my story. Anmol has this long-term capital gain on today. as on today, 16th of December 2022. The company, Ratan Limited, needs to be incorporated either during this financial year, which is from 1st April 2022 till 31st March, or the due date of return filing, which would be 31st July or 30th September or 30th November, as the case may be. The due date of Anmol, and again, not of the company. There are various minor intricacies involved here. The second condition is that Anmol should hold at least 25% of the voting power in Ratan Limited. At least 25% needs to be held. And the third and the fourth condition are simply these, that Ratan Limited needs to be engaged in an eligible business. Ratan Limited needs to be an eligible startup, which we already are, which we already have discussed. Now, the third condition, we've discussed two conditions so far. Condition number 3, once Anmol has subscribed to these equity shares, Ratan Limited needs to now purchase new assets from the money which is invested to it. Now, what exactly is this new asset is a simple case of black and white. So I'll just show you this slide, but we won't get into the details of it. I'd rather like to bring a very interesting gray area over here to you. The section says that Ratan Limited should invest or purchase these new assets within 1 year from the date of subscription. What exactly is this date of subscription is my question, which is unanswered as of now. Is it the date Anmol paid money to the company, or is it the date the shares were actually allotted to him? Of course, the benefit would be available only if the shares are allotted. But this remains a question, because the date, in my opinion, wherein he has subscribed is the date he paid money to the company. Now, to reiterate things to you, Anmol has sold his property, invested the money into the company, company bought new assets. If the cost of this is the cost of the new assets which Ratan Limited has purchased, this on the other hand is the net consideration which is invested. If the two are equal, which means if the new assets purchased are equal to or higher than the net consideration, the entire capital gain is exempt in the hands of the assessee, which is Anmol. But if not, if the company has purchased lesser new assets, then only proportionate capital gains will be exempt. Now, this section is undoubtedly no different in terms of this CGAS scheme, wherein if any of the amount remains unutilized, it needs to be invested into a separate account but till the due date of return filing. Whose due date? Anmol's due date of return filing. The question which is there over here is that it requires the assessee, Anmol, in his ITR to give the department a proof that Ratan Limited has adequately invested this amount into this CGAS account. With no attachments permitted in ITRs, this again seems to be an issue according to me as to how exactly would we invest or how exactly would we give them a conclusive evidence of this. And there of course is this lock-in condition of 5 years. Anmol cannot sell the shares which he has subscribed to. Ratan cannot sell the new assets which he has purchased for a period of 5 years from the date of their respective acquisitions. Now, there is this interesting question which I would like to give you a food for thought, and probably we could have a discussion over it if you are willing after my session. How many assessees, according to you, would be able to benefit from a single startup? How many Anmols can benefit from a single Ratan Limited via Section 54GB? A food for thought, because I can see my time running out, and I'd like to drop a conclusion right here to you that having discussed all of these sections with you at length, my simple analogy for using Ratan Limited and Anmol is to conclude by saying that all successful startup stories of our country are indeed the Anmol Ratan of our country, which is nothing but the priceless jewels, the precious jewels of the country. With that, and for the lovely opportunity of being heard, I sign off. Dhanyavadagalu, Bengaluru. Thank you.
Thank you for your insights, Anish. Moving on to the second student speaker, we have
Karthikeyan Shaktivel from Kanchipuram, who is a tax enthusiast. He has also presented paper in the national conference held at Chennai and also has written articles on taxation which got published in various journals. Karthikeyan will be taking us through Section 56 of Income Tax Act. Over to Karthikeyan.
Biraya, Raja Krishnappa Biraya, right? Do we know him? Yeah, go for it. Woo! Yes, that's the spirit, right? I come all the way from Chennai just to hear this crowd's noise here. Fantastic, right? In the economy, there are many Raja Krishnappa Birayas, right? That is nothing but the startups. Correct? Am I wrong? Every startup is being run on its capital base, right? So basically, capital is one of the important sources of funds for a startup, and we as CA students have the responsibility to support the startup since we are partners of nation building, right? Yes, perfect. So there I introduce my topic, which is taxation in respect of shares of startups, right? So first we'll just, sorry for a minute. Yeah, so first we'll just discuss, no? Share capital is basically a capital receipt. When I'm going to issue shares, I'm going to get money, which is my capital receipt. Can somebody tax capital receipt? They can tax revenue receipt, right? Can't the capital receipt be taxed first of all? Is it yes or no? Yes? But see, a capital receipt can be charged to tax if and only if there is a specific charging section, right? As per section 56 to 7B, which was introduced in Finance Act 2012 from assessment year 2013 to 14, says that if at all a private company or an unlisted public company is going to issue shares at a premium for more than FMV, then the amount shall be charged to tax at 56 to 7B. Just to repeat, if a private company or an unlisted public company is going to issue shares in a premium which is excess than its FMV, then such can be taxed under the head income from other sources under section 56 to 7B. Shall we just take an example here, right? See, Karthikeyan Limited is here, having a face value of rupees 10, share premium 140, and the issue price in which I am going to issue shares is 150, but my FME is 100. What is the amount taxable under 56 to 7B? Yeah, I am not able to hear here. What is it? Yes, it is 50. Intelligent Bangalore audience, right? So, hearing the word FME, two sections will come to our head immediately by studying in intermediate, right? Section 56 to 10 and 50C. 50C is for land and building, but 50CA is for sale of shares in case of unquoted shares, right? Assume, for example, my friend Anis is here and Kripa is here, right? They are investing in my company, they have my shares. They are going to sell it to Ajay Rotti, sir, for a sale consideration of 100 and the fair market value is 150. So, in this case, first we need to understand that in the hands of seller, take Anis is the seller and Ajay Rotti, sir, is the buyer, right? In the hands of seller, whenever the seller is selling shares below the FMV, such amount will be taxed in the hands of the seller. It will be included in the sale consideration. Same is the case with buyer, right? If at all an assessee is getting any shares for a consideration which is less than its FMV, then the difference between the FMV and sale consideration can be charged to tax under section 56 to 10. Okay? Am I clear? Yes. We'll just see what is the issue basically here, right? See, is there a cash inflow for them to first pay tax? See, for Ajay Rotti, sir, there is a cash inflow because he is for Anis, there is a cash inflow because he is selling the shares. For Ajay Rotti, sir, is there a cash inflow to pay the tax under 56 to 10? No. Is this first an income? Is this an income first? This is a deemed income, right? This is not at all income. Something which is not income, is it taxed only once? No, it is actually taxed twice. First in the hands of Anis and again in the hands of Ajay Rotti, sir. So this is the issue here, right? So in first case in 56 to 7B, when I am going to issue shares for more than FMV, I will be charged. In this case, if I am going to sell less than FMV, again I am going to be charged. Okay, what is FMV then? We just need to have that question, right? Do we have that question, what is FMV? Do we have that question, or shall I just skip this slide? Do we have that question? Yes, right. So we'll just see what is the FMV. The method of valuation for both 56 to 10, 50 CA and 56 to 7B is given under Rule 11 UA. For the purpose of 56 to 10 and Section 50 CA, the method which is being prescribed is net assets value method. But in case of 56 to 7B, in section itself there are two options. Either it can be a value which is determined as per Rule 11 UA, or it is the value which is substantiated by the by the assessee to the assessing officer. Is that possible? Can we substantiate? Can we say, if at all we are in articles, right, we would have seen this. Firstly, will the assessing officer accept the value which is given by us? So generally in practice what will happen is Rule 11 UA will be used. Under Rule 11 UA, basically there are two different methods which is being prescribed. The first one is the net assets value method, and the next one is the discounted cash flow method. We'll just have a doubt. 56 to 10, 50 CA also net assets value method. Rule 11 UA also net assets value method. Is there a difference between these both? Yeah, there is a difference between the net assets value method as per 56 to 10 and the net assets value method as per Rule 11 UA. As per, for section 56 to 10, you will take fair market value of most of the assets, book value of the remaining assets, and will deduct the liabilities. But that is not the case of Rule 11 UA. You will just take the book value of the assets. Okay, we'll just see now what is the discounted cash flow method, right? See, I am the assessee, I am standing here and I am going to project my 5 years cash flow. First year I am assuming it to be 200, second year 200, third year 200, fourth year 200, again fifth year 200. So I am just discounting the cash flow and I am finding my value is 758. But at the end of the fourth year, suddenly assessing officer comes. He is just asking me the valuation, right? So he is having the value for 5 years and he is telling that, boss, this is not the value. He is telling that, see, for first year you have earned only 150, for second year you have earned only 150, for third year you have earned only 150, for fourth year you have earned only 150, for fifth year also you have earned only 150, but you are projecting rupees 200 per annum. Is this correct first? Can an assessing officer question a valuation which is done by a merchant banker? Generally, if it is a case of fair market value is determined under DCF method, right? It needs to be certified by the merchant banker. Is this actually certified? Can the assessing officer reject this valuation? Yeah, I'm just waiting answers. Yes or no? Can an assessing officer reject the valuation? Yes. Put your hands up. Put your hands up. Yes. How many of you say no? No, boss. Assessing officer cannot reject the valuation. Can an assessing officer reject the valuation or not? Yes. Put your hands up. No. Put your hands up. So this is the question, right? So as we are divided, the judicial proceedings are also divided. See, the Delhi High Court and Bangalore High Court has held that valuation under DCF method can be rejected and the assessing officer can adopt a different value. But it should not be done without verifying the possibility of correctness of the data. The Bangalore High Court in Innovative Payment Solutions has held that the assessing officer can reject it, but he cannot change the method of valuation. In Rule 11 UA, we saw that there are two methods of valuation which may be adopted at the option of the assessee, but it cannot be changed by the assessing officer, right? But interestingly, Madras High Court and Bombay High Court has held that method of valuation is the option of the assessee and the assessing officer does not have anything to do about it. So what needs to be done is, we just need to know that the valuation report should be supported by the empirical data and valid assumptions for the valuation report not to be rejected. So we just saw that section 56 to 7B was introduced in the Finance Act 2012, right? The same similar section was introduced in the same Finance Act, which is a provisor to section 68. Yeah, are we on page? It's because I am just speaking and you are also speaking what? Yeah. 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 Is it better now? Yeah. Is it better? Yes? Yeah, perfect. See, section 68 was introduced by Finance Act 2012 and one more section was also introduced by Finance Act 2012, which is 56 to 7B, right? Section 68 is also introduced by Finance Act 2012. Basically, a proviso was inserted. First, let us understand what Section 68 speaks about, right? As per Section 68, whenever any amount is credited in the books of the assessee and that amount is not assessee, the assessee is not able to substantiate the valuation, in that case. See, as we are confused, the text is also confusing when we are discussing Section 68 here. Okay, come on, let's again focus. Whenever, yeah, shall we? See, as per Section 68, whenever any amount is found to be credited in the books of the assessee and the assessee offers no explanation, that extra income, basically that amount for which the explanation is not provided, shall be added as the income. But Section 68 was already there from 1922 Act, right? Basically, a proviso was only added. As per that proviso, whenever a private company or unlisted public company issues shares and the source is not identified or source of source is not identified, then in that case, the entire sum received will be taxable under Section 68, right? So let's just see an interplay between the three sections which we discussed from first, right? What is the first section we just discussed after coming here? 56(2). What was the next section? 68. What was the third section? There itself we just discussed, right? 56(2)(10). Do we recall all those three sections? Okay. We'll just now take 4 different scenarios and analyze how a single transaction is being taxed under these 3 sections, right? We'll just take the first case. I'm just going to issue my shares for 100 and my FME is 150 and the source is known. See, if source is known, Section 68 cannot come, right? So Section 68 is ruled out. Since my issue price is less than my FME, my 56(2)(7)(b) will not be there. So only section which is going to be applicable is Section 56(2)(10). We'll go to the next thing. Same case, issue price is 100, fair market value is 150 and source is not known. In that case, the taxable amount under Section 56(2)(7)(b) will be nil. The taxable amount under Section 68 will be 100 lakhs because source is not known, right? If source is not known, I'll be taxing that amount under Section 68 and similarly my 56(2)(10) as in the previous case it will be 50 lakhs. See, as Karthikeyan Limited, I'm just going to get 100 lakhs for this issue of shares and I'm going to be paying tax on 150. Third and fourth situation is similar, so we'll just go to the fourth situation. See, basically where the issue price is 200 and my FME is 150 and the source is not known, no amount will be taxed under 56(2)(10). But under 56(2)(7)(b), 50 lakhs will be taxed and under Section 68, 200 lakhs will be taxed. So I receive 200 lakhs and I'm going to pay 250 lakhs tax. I'm going to pay tax on total 250 lakhs. Okay, what is the rate I'm going to pay tax on? Shall we just see that? Under Section 56(2)(7)(b), if I'm going to opt for Section 115 BAA, my rate is somewhere going to be 25.168%. I'm just rounding it off to 25%. And under Section 68, it is going to be 78%. Basically, it is 60% plus surcharge plus cess. So it is 78%. So the effective tax rate is 103%. Right? With all these issues, do you think the startups can live with Section 56(2)(7)(b)? Yes or no? Since it just downgraded the economy, right? The government itself introduced a relief to the startups basically for applicability of Section 56(2)(7)(b), for which they need to file Form 2 and they should be an eligible business and eligible assessee as Anish told under for Section 80 IAC. So basically if I'm going to receive less than 25 crores, I should not my turnover should not cross 25 crores and I should be in a specified business, but I'm going to get more than 25 crores, I should not have invested in the list of assets. List of assets, it is basically not the value assets. We'll just put it that way simply, right? So these are some issues which is actually requiring consideration here. Basically the DPWIT registration is not that easy to get. There are different valuation rules for different sections and non-cut substitution is also there. So we as future chartered accountants, let us support the startups to become the Rockies.
I think the applause says it's all. Thank you, Karthikeyan, for this energetic session. Also, I know you all have taken a lot of pictures over here today, but I don't see anything coming on our Instagram. So use hashtag Kshitija, keep posting, please tag Sikasa Bangalore. And there is one more request, please do maintain the decorum of the session. Do not speak when the session speaker is presenting. And over to Bhavana.
Now, to present the next session, we have with us Krupa D to share her insights about ESOP taxation for startups. A CA finalist, Krupa D is an exuberant conversationalist with a knack for writing. Her articles have been published in various magazines and newspapers, including The Teenager Today and The Times NIE. Over to you, Krupa.
Hello and a very good afternoon to one and all present here. I think lunch already digested. Good afternoon! Right. So as we are all here, the alphabet K is in a lot of buzz. As emphasized by my previous speaker, K for KGF, K for Kshitija, K for Karnataka. I am K for Krupa, coming all the way from Chennai to talk to you about ESOP taxation. Yes, also K for Kaveri. So from where I come, it is really good manners to say hello with a cup of coffee. So today I bring to you Starbucks, along with a really fun fact about the company. In a company like Starbucks, from the baristas that serve coffee to the senior level management, everybody is given stock options of the company, making them a small owner of the big company that they are simply a part at. There are many old Indian companies like Lijjat Papad which owe their success to the concept of ESOPs. With their motto of Sarvodhya, they have managed to survive as market leaders for more than 50 years. The word Sarvodhya means progress for all. Now I know what you must be thinking. It is already 4 o'clock. It is time for tea. She is coming on stage and talking to us about food. How unfair of her. Well, yes, I feel you. So I will try and not take more than 15 minutes of your time to explain everything you need to know about employee stock option plan or ESOPs. They are options given to employees of the company to enable them to purchase shares after a specified period at low or no price at all. As the picture suggests, they're like a ladder of growth given to the employees, particularly employees of startup, giving them wealth creation opportunities along with the success of the company. They motivate employees to give in their all to the company, just like we articles given our all to our articleship firms. Just because the success of the company translates into financial rewards in the hands of employees. As we know, startups are companies which are only starting up and cannot afford to pay fat salaries in cash like well-established companies, and retaining talented employees has always been a problem for them, and therefore they include ESOPs as a part of their pay packages to retain talented employees. In fact, a recent survey has revealed that around 90% of the startups, 90% issue ESOPs even before the employee accepts the offer. So, ESOPs have been nothing but a superpower in the hands of employers of startup. As we know, and as Spider-Man suggested, with great power always comes great responsibility. And in our case, the superpower of ESOPs comes along with the responsibility of paying taxes thereon. There are dual tax implications on ESOPs. One, when the employee exercises the option, they're taxed as a perquisite in his hands. And two, as capital gains when these shares are sold. First things first, let us understand the perquisite part of the taxation. Now, these options are issued in exchange for service of employment. So, it only makes sense to tax them under the head salary as a perquisite. the taxable value calculated as fair market value on the date of exercise as reduced by the amount collected from the employee for the same. Let us understand this with a small example. I want you to listen to this example very carefully, okay? Krupa, age 21, very hardworking and diligent employee at Tea Time Startup Private Limited, was offered 100 share options of the company at rupees 10 on 1st January, being the grant date. The scheme vests on 1st April being the vesting date, and the employee chooses to exercise these options on a very auspicious day for all of us seated here, being the Chartered Accountants Day. The fair market value on which date was rupees 70. So the taxable value is calculated as rupees 70 as reduced by rupees 10. This value is to be included in the employee's income to be taxed at slab rates. Second, the capital gains tax. Once these shares are transferred, they become an asset in the hands of employee, and when these assets are sold, they attract capital gains, being calculated as sale value as reduced by fair market value calculated in step 1. So in continuation with our very beautiful example, Krupa, very hardworking and diligent employee, chose to sell these shares on 14th February 2023. Must have been another auspicious day. I am not aware why. For rupees 100. So rupees 100 as reduced by rupees 70 will become the capital gain in her hand, taxable at capital gain rates. The period of holding being from the date of allotment of shares or from the date of exercise till these shares are sold. Wow, I want you to take a deep breath and congratulate yourself, for you have now understood the very basics of ESOP taxation. But I am about to explain a very amazing chronology to you. This chronology is so amazing that it literally exists nowhere else in the whole of the income tax law. So with effect from assessment year 21-22, the law was very welcomely amended in favor of startups. So, as we have just studied, that when the employee exercises options, they become perquisite in his hands, when naturally attacking TDS provisions. So, for employees of eligible startups, the TDS can be determined at one point, but needs to be deducted only way later. That is on the happening of one of these three events, 14 days from the happening of one of these three events, being expiry of 4 years, 2 sale of shares, and 3 termination of employment. Obviously, we are going to understand this only with the help of examples. Scenario 1, Krupa, very hardworking and diligent employee at Tea Time Private Limited, chooses to grow old on her desk. So 4 years after she has exercised the options, the TDS needs to be deducted in her hands, which was determined in previous year 22-23, being the year of exercise. Moving on, scenario 2 being sale of shares. Now say for example, if the employee sells the share before completion of 4 years. In our case, Krupa, very hardworking and diligent. So 14 days from sale of shares, TDS will have to be deducted, which was determined in 22-23, being the year of exercise. And case 3. 1 year after exercise, the employer chooses to say, Khatam, Tata, bye-bye, goodbye to the employee. So 14 days from termination of employment, TDS will have to be deducted, which was determined in the year of exercise. Now that we have beautifully understood the provision, let us understand why such a provision is put in place. See, when these shares are transferred, no doubt that an asset is transferred to the employees. However, no real cash flow is transferred. Therefore, keeping the liquidity concerns of the employee in hand, such postponement of TDS has been put in place. There are similar amendments in TDS, Self-Assessment Tax and Recovery Notice sections. There are very many ways that a person can cash out of an ESOP scheme. But the one in recent fashion is the ESOP buyback. So much in fashion that the employees of startup made around 159 million US dollars in the year 2021 just through ESOP buyback. So let us understand the tax implications of buyback of ESOPs. So in case there is a buyback in the hands of employee, one of the TDS conditions is triggered because there is a sale in the employee's hands, but the capital gain tax becomes exempt as the incidence is transferred to the employer, who will have to pay buyback tax at the rate of 23.296%. However, in case of no buyback, the employee might have to wait a little. Patience is a virtue. So far, so good. The ESOP scheme has only been all glittery to us. We also know that India has crossed 100 unicorn startup mark. There has been a boom in funding. But on the flip side, there are so many startups which are very skeptical to applying these ESOPs. They do not even know about their existence and do not intend to know about their existence. So apart from other difficulties like lack of knowledge, implementation difficulties, what concerns us the most is our beautiful and beloved income tax. So let us see what issues are actually faced by the startups. Welcoming you to the dark side of ESOP taxation. So my very first concern being the taxable value is calculated using a fair market value, which is calculated by a category 1 merchant banker. Now, generally, any value of a company is calculated using discounted cash flow method or comparable transaction method. But in my opinion, it makes no sense to apply such methods to startups because they are innovative models and they don't really have comparable companies. And 2, discounted cash flow method cannot be applied because startups do not have reliable earnings, much less reliable revenue. My second point being the TDS. Determining TDS 1 point but deducting it only way later can actually be prejudicial in many cases to the employee. Say for example, Krupa, very hardworking and diligent employee. At the time of deduction of TDS, the salary is not sufficient for such taxes, so the employer may ask her to pay it out of her own pockets. In case the employee fails to plan the cash flow well in advance, then they might not be able to benefit so much from the scheme. Sadly, as we just saw today, a lot of startups land at a speed faster than at which they take off. So in case the valuation of a company drops, there are 2 downsides in the hands of employee. The first one being, when the value is high, you are taxing the employee perquisite at slab rates, going up to very high percentages like 42. But subsequently, when valuation drops, you are allowing a loss only at comparatively lower percentage. And secondly, capital loss cannot be set off against salary. So unless the employee has any other means of capital gains, there's not much that the employee can do with such taxes apart from sitting in a corner and crying about it. The other minor issues being, this scheme is applicable only for 80 IAC startups. So if the status of startup changes from eligible to ineligible, then the employee might not be able to benefit without any fault of his own. Termination of employment is one of the taxing points. However, if the termination happens due to death or illness, there is no leniency in the law for such factors. And lastly, cashing out of the ESOP scheme is very difficult for any employee of a startup. Startups tend to use the funds they receive for technological advancement of their business, and the employees might have to wait a long time before they can see the light of the day. So, there are many people like Mr. Subramania SV, who is the founder of a Fisdom startup, who goes around saying things like, giving ESOP to your employee is like slapping your employee and giving him money to go consult a doctor. So let us conclude if the ESOP scheme is actually good or bad. Well, in my opinion, ESOP scheme is one of the means by which a salaried employee can become a multimillionaire, because the examples of ESOP include companies like Flipkart and Myntra when they were only starting up. The employee needs to carry out his due diligence before accepting to such an offer, placing importance on success, valuation, and liquidity of the company. And as one of the full forms of the prefix CA stands, complete awareness needs to be spread among employees so they do not fall for any devil in the details. And last but not the least, throughout my presentation, I have only been using one example. Krupa, very hardworking and diligent employee at Tea Time Private Limited is for two reasons. The first one being, most of you seated in this room here today are going to be hardworking and diligent employees or employers. So you need to know about the ins and outs of this scheme, and I have obviously been trying to create the Drishyam effect, letting you know that it is very important to have a Drishyam or a point of view of such a scheme, which is so much in fashion. And now, Krupa, very hardworking, diligent employee, will actually join you at tea time. I hope you have a very splendid session ahead. Thank you.
Thank you, Krupa, for this wonderful session. I also thank all the speakers of this session.
Now I request our session chairman, CA Ajay Rotti sir, to address the gathering.
Thank you, Anish, Karthi, and Kripa for the wonderful sessions, and the effort that had gone in each of the presentation was visible. I think, in addition to all the things you learned in tax, one other important takeaway from this, and which what I shared with all three enthusiastic, bright fellow students, was that it's important that you maintain your own individuality and style. And you saw three presentations in three completely different styles, each of them effective, each of them efficient. There is no set things for some of these things. While you are in sessions like this, in addition to the technical things, these are important aspects which you need to pick up. So when you deal with clients as practitioners, or when you are in companies, working for companies, making presentations, you need to have your own style, be comfortable with the language that you are using. There are no set things that this is the way to perform, this is the way that you need to be, and that's, I think, another very important takeaway. Thanks all three of you. Excellent presentations and very good efforts. So, there were three very critical and specific aspects that the three of them discussed, and these are things which are really in some cases troubling, in some cases helping the startups today, whether it is the incentives available, and there are issues there like Anish finally brought out, including the aspects relating to what happens if a turnover gets increased 1 year in between, what happens if a plot of land is sold which has residential and commercial property, and whether you are eligible, not eligible, or the aspects relating to issue of shares that Karthi discussed. And that's another important thing, and this is a classic case of throwing the baby with the bathwater. Why were these provisions brought in? These were brought in because of what happened in the 2G scam, where there were companies, shell companies, which had nothing but a telecom license, which started issuing shares at a huge premium, and money the government believed, and rightly so, was laundered using those routes. So therefore they brought in these anti-abuse provisions which limit those abuse, and therefore the shares have to be issued in line with the fair value, and there's an unintended consequence that some of the startups are impacted because of the method of valuation prescribed, etc. And equally important are the aspects in ESOP that were brought out by Krupa, relating to TDS, timing difference, valuation, and that's a very critical aspect, because you can't value companies, some of the existing, or the new startup companies, basis cash flow and things which we are traditional valuation methodologies used. So where do we as chartered accountants play a role in some of these things? One is, making sense out of all of these madness for the clients, taking a balanced approach there, advising them right, and also equally important, make our voices heard with representations and things like that, where some of these can be changed. There have been multiple instances where issues like this, which are practically known only to us as set of practicing accountants or accountants in industry, that have been brought to the fore, highlighted to the government, and things are changed. So these are things that you need to keep in mind. What I thought I'll do over the next 10 or so minutes is, in addition to the three specific things that are discussed, what are things that you need to be aware of as you go into the industry, as you go into the practice and start working with startups, or you found your own startup? What are the things that you should be worried about? And these are some small things. There could be larger things. I think the most important thing that I have been seeing is startups today are there's a lack of awareness on some of the aspects relating to compliances, what the law requires, etc., because they're growing at a pace at which traditional companies were not growing at. You know, companies start and then they are hiring people within few weeks, they're having IPs within few weeks, they're having contracts with cross-border contracts within days. And also the traditional businesses were more domestic and more inward focused, because that's how the country was back then. Today, a startup, you take a Paytm, you take anybody, by the time they are a unicorn, they most certainly have operations outside India. Therefore, how do you equip, how are you aware of what are the laws that need to be followed, what filings need to be done, what are the compliances that need to be done? There is a bit of lack of awareness here. That's one of the big challenges that I've been seeing. Similarly, on process, documentation, etc., I have seen startups which are, you know, just weeks old, entering into crores of contracts, payments being made using credit cards, using personal accounts. Then how do you document that? How do you have vouchers? How do you build your documentation? These are things which are missing. Again, this is because of the kind of people who are starting today. It's a very good thing, because these are first generation entrepreneurs who are just out of college starting companies, as against people who have been in industries, seen larger setups, seen processes in companies being there, and then you come and start your own company, you know where to start. But if you are out of college and then you are starting a company, some of these would be missing. So that's where we can play a role. Choice of entity, what do you do about timing, decision on ESOP. Like Krupa was telling, it's an absolutely fantastic tool to reward your employees, but you need to get your timing right. There are a lot of these companies which time their ESOP wrong. You know, you issued ESOPs at a very high price and employees exercised, ended up paying, you know, 42%, 36%, 37%, whatever rate it could be. And then today when the listing has happened, the shares are trading lower and then you have losses. The point that Krupa highlighted, that you will not be able to set off, you don't get those benefits, but you ended up paying tax. So therefore, getting ESOP decisions, timelines, and how do you do this right? This is another place where we can definitely play a role. The fourth one is again significant. How do you choose between employee versus an independent contractor? In these gig economies, whether it is a Zomato, whether it is Uber, Ola, etc., across the globe, it has nothing to do with India. Across the globe, they are facing issues on whether these are employees, do you need to comply with social security? So come back to India, Provident Fund applies, ESI applies, they don't. Are they employees? Are they not employees? There's again a lot of issues and challenges that companies are facing in this aspect as well. And then therefore, you know, when you're structuring the company, when you're structuring these contracts, that becomes important. Withholding tax compliances, not again with lack of process documentation, withholding tax always takes a backseat. Currently, the government, rightly so, for the last few years has been focusing on withholding tax compliances. It's an easier source of revenue for them. As and when the transaction happens, money comes in. And why would government focus more and more and broaden withholding taxes? Is because they don't get revenues in lumps, they get it on a monthly basis. The more transactions get into withholding tax, the government collects revenues on a regular basis rather than wait for advance tax installment. Number one. Number two, a lot of transactions come into the net, come into their radar. So withholding tax is increasing, but that compliance also needs to be seen. A lot of companies undertake restructuring, a lot of these startups do acquisitions, a lot of them have losses. There are regulations, there are rules relating to change in shareholding with losses going away, 79, etc. There are no relaxations there, so that's another very important aspect and a big challenge that today a lot of startups are facing, because to exist they need to merge, they need to acquire, but then they end up losing losses. Last but not the least, significant aspect again, and like I said, because the new age companies today start up and they are global in no time. They don't wait. It took ages for the Tatas, Birlas, etc. to have subsidiaries abroad, have operations in countries outside India, but that's not the case with the new companies, which is a very good thing. You take a Cred, you take Paytm, you take any of these companies just coming to my mind, all have overseas subsidiaries. You look at the Paytm balance sheet, just download it. They'll have more operations, more companies outside India in countries that we will not have even expected, more than any of the other established groups. So this leads to a challenge that on day one, and in some cases day zero, the new age companies and the startups are required to comply with transfer pricing. And I'm aware of very large Indian companies, very large successful Indian companies who actually don't have transfer pricing issues because they don't have overseas transactions, they don't have overseas subsidiaries, they are very inward focused. And therefore that's another aspect that all of us could play a huge role in. I think importantly, like I began the session with, identifying these issues, critical, it's a huge responsibility and a role for all of us when we are getting into whichever side of whichever side we choose to be in, and that's a classic debate between being in the industry and profession, and both are great, believe me. And whether you choose to sit in a company, handle taxes, be a CFO, handle finance for companies, or you are in the profession advising companies, helping companies, consulting, having a right balanced approach to taxation has become extremely critical and important at this point. Therefore, that I would want you to take away, along with all the technical aspects that you have learned today. Once more, big round of applause to Anish, Karthi and Krupa for the great job that they have done. Thank you so much for the patience.
Thank you so much, sir.
I hope you all got an insight on the taxation of startups. Now, to give our token of gratitude to the session chairman and a token of appreciation to all the speakers, I call upon CA Manjunath, member of Managing Committee, Bangalore branch of SIRC. A big round of applause for CA Ajay Rotti sir for accepting our invitation and being here with us today.
And to all the speakers, Krupadi, Anis and Karthikeyan, thank you so much.
A big round of applause, guys.
And as we have already told in the morning session, this time we are giving a bouquet and not a bouquet. We are giving books
Instead of bouquet.
Now I call upon Ms. Apurva to deliver the vote of thanks.
Respected dignitaries on and off the dais, I am delighted to have this opportunity to propose vote of thanks. I would like to thank Mr. Ajay Rotti, the chairman of the session, for the insights provided. I would like to thank our student speakers for taking the extra steps and making us understand complicated topics with the great ease. Thank you one and all.
Thank you.